Hey guys, today I'm going to be speaking to you about a topic that we as South Africans hear a lot about, but actually not many of us fully understand what they actually mean. And this is the difference between monetary policy and fiscal policy, guys. And during the last couple of months, due to all the stuff that's been going on all over the world, guys, these two terms have been thrown around quite a lot. Like, you would have heard them in government debates, you would have heard them on the news channel when economists are having debates about where our country should go with this pandemic issues that we had in the last couple of months. But basically, guys, I'm going to explain what these two means, because they throw these words out there, but lots of people don't actually know what it means. But monetary policy, guys, is basically the control of the money in your economy, guys. You're controlling things like your interest rate, your exchange rates, your money supply, guys. You're controlling that to control basically the demand of your economy, guys. Monetary policy is there to try and promote spending, or maybe sometimes not promote spending, maybe try promote saving. You'll see as I go into it when I explain later. And then I'm not going to explain much about it today. I'll do more on it in the next video. But fiscal policy, guys, fiscal policy is basically, it's the more supply side, but it's basically anything that involves government spending, guys. Is that the government taxes us every month, guys, and people get upset about the taxes, but that money doesn't go nowhere, guys. It goes to what's it called? Government-run businesses, so like SAPS, so like the South African Police Service, some public hospitals, guys. They use that money to build roads and stuff like that, guys. So they basically, fiscal policy is there to improve the infrastructure of our country. But as I said, we're not here to speak about fiscal policy. Let's speak about monetary policy. Okay, so the four things that you basically need to know about monetary policy before we go into a bit more detail is that it's controlled by the central bank, guys, so it's not controlled by the government. The two work together and they constantly in discussion with each other because they want their policies to match, but it's controlled by the central bank and not by the government, guys. And it handles the demand side of the economy, guys. You'll see it more as we go a little bit further into the video. But every single effect that they do is going to affect the demand of the economy a lot more than it's going to affect the supply. So we say that it handles with the demand side. You get two types, guys. We're going to go into each of them in a bit more detail just now. We get expansionary monetary policy and contradictory monetary policy. And guys, it literally means what those words say, guys. If you're looking at expansionary monetary policy, it's monetary policy put in place to expand the economy. And then if you're using contradictory monetary policy, it's monetary policy in place to reduce, well, not reduce, but try slow down the rate at which the economy is growing. Okay. And what monetary policy tries to do is that they try to find the equilibrium between inflation and economic growth, guys. And I'm going to explain that a bit more. But the issue with excess economic growth, guys, is that if your economic growth is growing too fast, guys, so you're growing too fast, this often causes hyperinflation, levels of inflation that are too high for your economy to handle. So that's what monetary policy tries to stop from happening. They try to find the equilibrium between the two. But let's go into some expansionary monetary policy. So as I said, expansionary, looking to expand the economy. And it promotes spending and economic growth, guys. So these are basically the things that they do to try promote people to spend more money so that the economy can grow. Because the more money that's flowing in your economy, the more economic growth there is, okay? And the ways they do this, guys, is that they set lower interest rates to promote borrowing and therefore spending, guys. So what the central bank does is they say, okay, we're going to lower the interest rates, okay? And now people realize, oh, okay, if I want to go get a loan from the bank, I don't have to pay as much interest in return. So I'm going to go get my thing now. So this promotes spending. And this actually, therefore, puts more money into your economy to be sent around. And that's why it's one of the reasons why it promotes economic growth. Number two, lower interest rates tend to cause lower exchange rate due to lower returns on investment, guys. This is one of the disadvantages to it, guys, is that the lower interest rates, although it promotes spending inside your economy and guys are happy to go borrow money and go spend their money, what happens is to all your foreign investors, guys, is that they see the lower interest rates. And when there's a lower interest rate, guys, it means that you get a lower return on investment. If they decide to buy an asset here in South Africa, it means that they're going to get less return on the asset. So this means that they're not going to be as motivated to invest in our country, and this lowers the exchange rate, guys, because there's suddenly not as much of a demand for our currency anymore. So because there's less people wanting to invest in our country. And then the last one, which the other two actually play a role in, but it's the increasing the money supply to increase spending, guys, is that basically is that if there's more money available in your economy, there's more transactions that can take place. So normally the two and two work together, the lower interest rates and the increase in money supply work together, because if you're going to have everyone borrowing money, you can't just pull it out of thin air, you're going to have to increase the money supply. Okay, and then I said here at the bottom, as you can see, although expansionary monetary policy causes increased spending and economic growth, all effects are inflationary and damaging to our currency, guys. And for that reason is that if you are promoting spending, guys, so you are giving people, you're saying, okay, come take money, go spending, you've raised the demand of your country, guys. And as we know is that a raised demand causes inflation, is that if people demand more, the price is going to raise, guys. So that's why it has an inflationary effect. And this is why we can't just go through expansionary monetary policy and just run through expansionary monetary policy. Because although we'll get some great economic growth, our exchange rate and our inflation is going to, our exchange rate is just going to drop and our inflation is just going to keep rising. So that's the reason why we can't just keep using expansionary monetary policy. So then they made up contradictory monetary policy, guys. So this is basically the stuff that the things that they do to try and make sure that inflation and the interest rate don't get out of hand, guys. They need to try make sure that those are still in a safe position. So they go through contradictory monetary policy, okay? And it promotes saving and better exchange rates and inflation rates, guys. So now they've said, okay, they went through expansionary monetary policy, everyone's been spending, now they say, yo, inflation's went up a little bit too much, guys. We need to stop people from spending as much. So then they higher the interest rates, guys, to promote saving, is because now if there's higher interest rates, people don't want to borrow money anymore, guys. It's because now they're going to have to pay huge amounts of interest. So what they rather do is that they go and save their money, guys, because now they're going to get more interest for saving their money, guys. So now they go put their monies in the bank, so they're going to get more interest. The higher interest rates cause higher returns on investment for the foreign investors, guys. So you remember what I was saying there about the lower interest rates? People aren't going to get as much money for their investments. Now, because we have higher interest rates, there's a lot more return for investment. So foreign investors are going to be motivated to invest in us, and this increases our exchange rate. And then the last one, again, they work hand in hand, but it's a decrease in the money supply to decrease spending. Is that if you don't leave as much money available in your economy, there's not going to be as much spending going on, guys. Okay. Then I said here at the bottom, although contradictory policy causes an increase in exchange rates and a lower inflation rate, it slows down the economic growth and therefore cannot be used for long periods of time, guys. And this is why our monetary policy has to keep on switching, is because although the one policy, yes, it increases our economic growth, the problem is that inflation and exchange rates suddenly become neglected and then they can get out of hand, guys. So that's why we need to keep switching between. At the moment, we're probably more focused on expansionary monetary policy because our economy is going through a bit of a recession at the moment, but all in all, a normal functioning economy will keep switching between these depending on the situation, guys. So basically, guys, that's all I'm going to speak about on monetary policy, guys. And basically, all you have to remember about monetary policy is that it controls three things, guys. Is that you control the inflation, the interest rates, and the money supply, guys. And then that, in turn, also helps the exchange rates and the economic growth of your country, guys. So that's all from today. I will see you guys next week for fiscal policy. Thank you.